Are you being forced to take $50,000 from your retirement account even though you don't even need the money? If you're 73 or older, the IRS doesn't care if you need the money or not. They're making you take a required minimum distribution, and most people are handling them completely the wrong way. I'm about to show you the 5 strategies that could save you thousands in taxes this year alone, and one of them is so powerful it could eliminate your future RMDs entirely. Let me tell you about Robert, successful contractor, built a $3 million retirement portfolio. At 75, he's been forced to withdraw $120,000 a year from his 401k. Problem is, Robert doesn't need the money. His business still generates income, his house is paid for, but the IRS doesn't care. They want their taxes. So what does Robert do? He takes the $120,000, he pays $30,000 in taxes, and he dumps the rest into a savings account earning 2%. Meanwhile, he's pushed into higher tax brackets, his Medicare premiums go up, and he's essentially being punished for saving too well. Sound familiar? If you're dealing with the excess RMDs, you're not alone, and you're definitely not stuck. I'm John Rojas, certified financial planner, and I've helped hundreds of business owners and retirees turn their RMDs from a tax burden into a strategic advantage. And with the 2025 tax changes, some of these strategies just got even more powerful. But here's the thing, most people wait until December to figure this out, which costs them thousands. So grab a pen because we're diving into 5 strategies that could completely change how you think about your RMDs. And if this saves you money, hit the like button so I know you're taking action. Strategy number 1, use your excess RMDs to fund Roth conversions. Back to Robert. His $120,000 RMD pushed him from a 22 tax bracket to a 24% bracket. But here's what we discussed. We used his after-tax RMD money to pay taxes on a $200,000 Roth conversion. Think about it. He's already paying taxes on money he didn't need, so why not use that tax payment strategically? And here's why 2025 is crucial. We're still in historically low tax brackets before the Tax Cuts and Jobs Act expires in 2026. This might be your last chance at these rates. Here's what happened to Robert. By converting $200,000 into his Roth, his future RMDs dropped by $8,000 annually. Take that over 10 years, that's $80,000 less in forced withdrawals. Now you're thinking, but John, I have to pay taxes on the conversion. True, but you were already paying taxes on the RMD. Now you're eliminating future RMDs and creating tax-free growth for your heirs. This works best if you're in the 22% or 24% bracket and expect to be in the same or higher bracket later. With 2025 standard deductions of 15.7 for singles and 31.4 for married couples, you've got some room to maneuver. Strategy number 2, qualified charitable distributions, or as some call it, the triple win. Meet Patricia. She's 76 years old, takes $40,000 in required minimum distributions, and donates $15,000 to her church every year. Anyway, she was taking the RMDs as income, paying taxes on it, then writing a check to her church. Here's what blew her mind. She could send that $15,000 directly from her IRA to her church and avoid paying taxes on it entirely. In 2025, you can do a QCD up to $105,000 annually if you're 70 and a half or older. The money goes straight from your IRA to the charity, never touches your tax return, and counts towards your required minimum distribution requirement. This is what I call a triple win. 1, no taxes on the distribution amount. 2, it reduces your adjustable gross income, which could keep you out of that Medicare premium surcharge. And 3, you're supporting causes you care about. Patricia's $40,000 RMD became a $25,000 taxable distribution, plus a $15,000 tax-free charitable gift. Paying $9,600 in taxes to paying $6,000 in taxes, that $3,600 back into her pocket annually. And here's something new for 2025. You can now do a one-time $53,000 QCD to a fund or a charitable remainder trust or charitable gift annuity. This is huge for larger estates. Strategy number 3, strategic investing in taxable accounts with a twist. Now, some of you are thinking, John, why would I put money into a taxable account when I have tax advantage space? And that's a great question. Here's why. This is actually brilliant estate planning. I worked with a couple, David and Linda, who had $80,000 in excess RMDs annually. They didn't need the income. They didn't want to convert everything to Roth and weren't big charity givers. So we took their after-tax RMD and invested it into a tax-efficient portfolio in a taxable account. Low turnover, index funds, municipal bonds for their tax bracket, some individual blue chip stocks, just a mix of things. Here's the kicker. With 2025's step up in basis rule, when David and Linda pass away, their kids will inherit this account at the current market value, all those gains tax-free to the heirs. So after 15 years, their $1.2 million in accumulated RMDs grew to $2.8 million. When they pass, their kids get $2.8 million tax-free instead of inheriting an IRA that would force them into higher tax brackets. Pro tip for 2025, focus on qualified dividends and long-term capital gains, which are still taxed at 0, 15, or 20%, depending on your income. Much better than the ordinary income rates on RMDs. Strategy number 4, timing and installments. Strategy number 4 is about mastering the timing game. Most people take their entire RMDs in December. Big mistake. Let me show you why timing matters. Remember in 2022, markets were down 20%? If you took your RMD in January, you sold at the bottom. If you waited until December, you sold after some recovery. Instead, take your RMDs monthly or quarterly installments. This gives you a dollar cost averaging on the way out, just like you had on the way in. For 2025, your RMDs is calculated on your December 31st, 2024 balance, but you have until December 31st, 2025 to take it. Use that flexibility. Here's an advanced move. If you're still working at 73 and your 401k is with your current employer, you can delay RMDs from that account until you actually retire. This is called the still working exemption, and it's completely legal. And if you're taking installments, coordinate them with your other income. Take larger RMDs in low income months, smaller ones when you have those income spikes. Strategy number 5, withholding simplification. If you're taking large RMDs, you might owe quarterly estimated taxes. Miss a payment? Hello, penalties. Instead, have taxes withheld directly from your RMDs. The IRS treats those withholdings as if you paid evenly throughout this year. Even if you take your entire RMDs in December, they will treat it like if you made those equal payments. For 2025, consider withholding 22 to 24% if you're in those brackets, but adjust based on your total tax picture. The beauty is it's automatic, one less thing to remember. I have a client who takes a $100,000 RMD with $25,000 withheld. He never worries about quarterly payments, never pays penalties, and often he gets a small refund. So here's a bonus strategy for the sophisticated planners: bunching. If you're charitably inclined, but your deductions are close to standard deductions, consider bunching 2 years of charitable giving into 1 year. Take this year's RMD, normally, pay the taxes, then use the after-tax money plus next year's anticipated RMD to make a large charitable contribution. This gets you over the standard deduction thresholds. With 2025 standard deductions at 31.4 for married couples, you need significant itemized deductions to beat it. Bunching can get you there. Here's what I want you to understand. RMDs don't have to be a burden. They can be a tool. Robert, who we met at the beginning, by implementing these strategies, he reduced his annual tax bill by $12,000, eliminating future RMDs on $400,000 of his IRA and creating tax-free legacy for his kids. You have a choice. You can let the IRS dictate your financial strategy, or you can take control, make your RMDs work for you. The business owners and retirees who get this right don't just minimize taxes, they optimize their entire financial picture. They sleep better, they stress less, they leave bigger legacies. Now, I know this might feel overwhelming. 5 strategies, multiple tax rules coordinating with your overall plan. That's why I created the RMD Optimization Blueprint. It's a step-by-step guide that walks you through each strategy with real examples in 2025 numbers. I'll put the link in the description. If you want to dive deeper, it's free and it might save you thousands this year alone. But if you're dealing with significant RMDs, we're talking $75,000 or more annually, you need a personalized strategy. Book a strategy session with my team this week. We'll analyze your specific situation and show you exactly which strategies will save you the most money. Fair warning though, I only work with 12 new families per quarter, and with tax season approaching, these spots will fill up fast. Click the link in the description, book your call, and let's make sure you're not overpaying the IRS. Remember Robert? He was being forced to take $120,000 he didn't need and pay $30,000 in unnecessary taxes. Don't let that be your story. Take control of your RMDs before they control you. Hit subscribe for more financial tips and strategies. I'll see you next week. Thanks for watching.